Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu. And these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today is part 2 of what we released yesterday on what we can now take away from the article on what Warren Buffett had said back in 1998. We found it to be quite prophetic. And let's see if some of the prophecy extends to where we stand today. Even though Warren Buffett has not commented on where we stand today, let's try to make use of some of the analytical tools he's provided for us so generously. So, let's examine some of the points which Warren Buffett had examined back when he gave this interview to Carol Loomis. So, Warren Buffett had basically looked at 3 points. One, the interest rate in the past 17 years, and then to see where the interest rate might go in the next 17 years. That's quite a long period of time. It's going to be difficult to predict where interest rates are going to go in the next 17 years.
Because you can't see what's coming.
You can't see
You can't see the black swans.
You can't see the black swans. But it is possible to see where interest rates were in the past 17 years. So, in the past 17 years, interest rates in the US have nearly hovered around close to 0%. And very recently, it has ticked up to 5.5%, 5.25 to 5.5%. And this is the highest it's been in a long time in the US. So, for the S&P 500, moved on from the Dow Jones to the S&P 500 because the S&P 500 is a more broad-based index, has 500 companies, and it's not an elite group. So, the S&P 500 has gone up quite a bit in the past year, I think about 6-7%. It's come down a little bit because of the recent jitters which it had faced. But it has done quite decently over the past few years. Especially, it has stayed afloat because of your Magnificent Seven. We've talked about this. Nvidia, Amazon, Google, Meta, and then you have Tesla, and 2 other, Apple, and then 1 more company which I'm forgetting the name of. But these are the companies which have kept the S&P 500 afloat. And in fact, it's taken it to sky-high values. And now they're sort of having a reversal. But most of the people who invested in Nvidia at the peak price in which we saw just a few weeks ago, they expected returns of, let's say, over 20-25% up till the year 2027, 2028. I mean, how can you even forecast that is my question. But let's assume you could forecast that. They expected a 28% return in their earnings in 2028, 2027, 2026 even. So what that made me realize was, look, interest rates, if it falls, which we are expecting it to fall, is it going to fall to 3%? Is it going to fall to 2%?
We don't know.
We don't know that.
How fast it will fall, we don't know.
We don't know how fast it's
and even if it will fall, we don't know.
It seems very unlikely to me that in the future, Jerome Powell will be comfortable keeping interest rate near zero. I think we're past the near zero for this cycle.
Something catastrophic has to happen for him to do that.
For him to do that. And
like 2007.
Like 2007. But the GDP seems to be fine in the US. GDP is hobbling along. You have job growth. Yes, job growth is robust, but the unemployment rate is going up. One aspect to this which we haven't explored yet is the fact that people who are out of the labor market, now seeing the economy is, sort of getting back to where it was before, after COVID, maybe joining back and looking for work. For those of you who are doing economics, have done economics, the unemployment rate has something which it suffers from called discouraged workers. These are people who were discouraged by the job market and stopped looking for work. So they don't report that they're looking for work. Although they are technically still looking for work, they haven't listed it. So they're not technically counted as unemployed. But we all know that they are actually unemployed because if given a job, they would take it up. So these kind of people are left out of the number. And this is a huge number. And today, these people might be coming back. So they might be going to their unemployment services office and they might be looking for work. So this is an important point. So the labor market doesn't seem to be doing too bad. And I don't think Jerome Powell has to panic and cut rates to near 0% anytime soon. So the interest rate point falls through. I don't see interest rates falling as fast as as the market expects it to. 2, corporate profitability in relation to GDP must rise. Two ways in which this can happen. One, Trump comes in, he cuts corporate taxes, and he gives corporates a field day. This is one thing. But then even in this case, Trump is also going to bring in tariffs. If he brings in tariffs, corporates are not going to do so well. So what it seems to me is that it's a mixed bag. I don't see any clear path in which corporate profits are going to rise in proportion to GDP. Do you see any sign? Because
no, and another thing is, even the recent market dip which we saw and bounce coming from that burp which happened in the market, if you see, like Sashwath said, the job numbers, it's more than that. The reason why that happened was also because of the carry forward trade which Anand and Sashwath have spoken about. The Japanese yen, Bank of Japan tightening, and traders who have been sitting and playing on this arbitrage now don't want to do this anymore. So that has led to, I would say, more of the correction was leaning on that than even the job numbers and unemployment numbers. Because like Sashwath says, the Fed didn't even blink when all that happened, because there's no reason for them to blink. And if the Japanese bank keeps inching up, trying to narrow the gap between the Japanese yen interest rate and the American interest rate, or Fed starts removing interest rates, that carry forward trade pressure is going to create more volatility in the market than anything coming out of American economy right now, because I don't see anything wrong in the American economy, like you said.
Yeah, and unless some numbers come out which tell us differently, I don't see why most people are panicking the way they are.
And another thing is, even when the 2008 crisis happened, the rate cut happened because it affected the homeland, American mainland directly.
And one of the three main factors, housing.
Correct. And it affected them straight on, head on. So they cut the rates immediately. Right now, there's nothing like that on the cards domestically in the American. Of course, there's something can happen.
Yeah.
Black swan, I agree. But even if something happens geopolitically, it's not going to force the Fed to cut interest rates so the American government can borrow money cheaper to do funding for some geopolitical situation outside US. It will only focus mainly on what's happening domestically and not really care about what's happening internationally.
And we're not saying they're not going to cut, but we're saying it's not going to be significant enough to create the kind of returns which these guys are talking about. It doesn't seem like it. It doesn't seem obvious from where we're standing today, from what we can see today.
And most importantly, when they did cut the rates in 2007, 2008, the stock market cratered. And it did not just because he cut the interest rate immediately start zooming back up to sky high again. It stayed there for quite a long time. It just stayed there because people were quite rattled. And the reason for cutting the rate was trying to, cajole people back into saying, don't worry, we're here.
Yeah.
So that is the reason why interest rates are cut. Interest rates are not cut because it's like, oh, you guys are having such a great party. Come on, let me give you some more drinks on the table. It's on the house now. Let's cheer. Don't worry. There's, it's happy hour non-stop. It's not like that.
Until you start buying your own.
Yeah. So for interest rate, remember, him raising the interest rate also was a delayed reaction. Inflation rate was gone. Everything was going sky high. Everyone was saying, when is he going to raise it? When is he raising the rate? He's going to raise it. It took some time for them to start doing it. Same way, when a crisis happens, for them to cut the rate, it will not immediately happen overnight. It's going to take some doing to get there.
And to Jerome Powell's credit, he seems to be thinking about it quite a bit in what he's doing. I have to give him credit where it's due. But you know how I see this? The carry trade especially, I think the 0% interest rate is like cigarettes for the S&P 500 and Wall Street. And when the 0% interest rate was pulled from underneath them, they went looking for nicotine patches in Japan.
Yeah.
And once Japan is now saying, look, boss, I'm not going to give you anything more. I need to look for my own economy. Now we're seeing
they're having a tantrum.
Yeah, we're seeing markets. Exactly. Tantrum. That's the word for it. We're seeing tantrums and we're seeing jitters. So that being said, that's the interest rate point covered. We looked at corporate profitability in relation to GDP. I don't see a clear way in which, even if Kamala Harris comes or Donald Trump comes, corporate profitability rising in percentage of GDP. Third factor, I do not see yes, the US economy is robust, but I don't see it growing at any percentage which justifies 22-26%. Even if Nvidia is exporting most of it, I don't see the global economy growing at.
Yes, because the main reason is American domestically, they don't consume. Consuming is not going to go up.
Yeah.
To the point where this growth rate is going to be met. Even any way to meet this growth rate has to be only through exports. And right now, the lockdown on what you call
protectionism.
Protectionism and free trade not happening, global trade not happening, is looked as shunned and people don't want to do it. It's going to be very hard for American behemoths to export and to do things outside. Like even Nvidia, to work around all this, are building factories all over the world. So they can supply whoever needs whatever locally and say, well, it's not made in US or it's not made in China, it's made here. Here, take it. So this is not going to happen at the pace you want it to, this growth.
So we've covered 3 points now. Let's look at the example of picking one winning sector. Okay, because this is something which people tell us all the time. People tell you all the time.
Yes.
They say, look, Vinod sir, Sashwath, why don't we pick one industry which we know is going to do well? We know AI is going to be the next big thing. No one disagrees with you. Why don't we just blindly invest in AI and forget about it for the next 10, 15 years? To this, Warren Buffett, again being the prophetic man that he is, he's given us an example, 2 examples. He looks at automobiles and he looks at aviation. He says, in 1998, over the past 70 years, no one will have denied that automobiles and aviation are going to be the 2 biggest industries to thrive. And no one can deny that. I mean, automobiles and aviation has become massive, exploded since when Warren Buffett was a child and today where he stands. But he says, I specifically didn't buy automobile companies. And even if I did, I got out of that very soon. And I specifically did not touch aviation. Yes, he touched it during COVID, but that's completely after the 1998 speech which he made. That was about 20 years later. But at the time of speaking this, he didn't touch automobiles, nor did he touch aviation. And he didn't touch these 2 industries because even though it's undeniable that these 2 industries are going to be the ones which are going to rule the roost, there were 2,000 car makers in the industry when Warren Buffett was a child. And by the time Warren Buffett gave that speech, there were 3 major car producers in the US. No one could have guessed when he was a child. Warren Buffett, if he was a grown man back then, couldn't have guessed which company was going to be the big hit. And even if you were some foreseers, some prophetic fellow who knew which companies are going to do, which are going to survive, even if you're invested in those 3 companies, the returns you would have made if you had just invested in the regular market would have been much more than if you'd invested in automobiles. Same for aviation. I'm sure a lot of you must know of the story of Pan Am, and a lot of you must know of the story of Kingfisher Airlines. A lot of you must know the story of Jet Airways, I think, which recently folded. So, and Air India, which is now sold.
Why? Just way back in when this article was written, no one could have predicted mobile phones. No one could have predicted social media. No one could have predicted Instagram, WhatsApp, TikTok. Nobody. It was not even something they could even dream of. If you had given them the most outlandish ideas to come out with, no one in investing would have said, this is going to be coming. This is happening.
Who would have guessed Nokia wouldn't be here today in mobile phones?
So, when you look at it from that perspective, mind you, today sitting here, you telling me 15 years from now, this is going to be there 100%. That's what Sashwath is talking about car industry. He's talking about aviation. That's why Warren even talks about. They're trying to highlight the same thing. They're trying to say, imagine, whatever age you were in, a world where there are no CDs. In my age, when I was young, to say there will be no CDs, you will not be requiring, to carry your music, download it, or whatever you were doing, that you don't need it. It's going to be all in some cloud and you can just access everything remotely. Internet speed is going to be so fast. No one would have believed it. Just 10 years, 15 years back, no one would have believed it. But here we are. So same way what Sashwath is saying is, it's impossible to see where the road is going.
Yes, AI might be the next big thing. We might have AI everywhere in the next 10 years. But how do you know which AI company is going to be profitable? We don't have a proof of concept. We don't have a company which has made AI profitable. And we don't know what kind of margins we're going to have. It's a zero-sum game. If you are using an AI, you're taking away from someone else's computational power.
And the biggest thing which most people who are enthusiastic about AI want to wash away and not look at is the amount of power, literally the amount of electricity AI is using. And the amount of power it's already taxing us. And what it requires for it to become sentient and do everything, whatever we're imagining it, the kind of power consumption we're talking about is phenomenal. And we are nowhere near creating that kind of unlimited power source. I know immediately there'll be people like, no, we'll figure it out. AI itself will tell us how to generate the power. Hey, if it was so simple, we'd all be very happy in life.
Yeah. But, this is not a tirade against AI.
No, it's not.
I'd rather be an AI user than an investor in
We
AI.
all use actually.
Yeah. At this point, I would rather use it rather than invest in it, because of the simple reason that I don't understand which company is going to be profitable,
Correct.
where they're going to make their money, whether AI is going to be everywhere, is it going to be regulated? I don't know any of this. And if you come up to me and you tell me that, look, the AI sector is where I want to put my money in, I'd say congratulations that you have come up on this idea, but are you sure you're going to be able to do this? Do you think that you have all the information you need to make an educated decision? This is something you have to ask yourself. And if you don't invest in AI, conversely, you would not be able to beat the market. So you're stuck in this sort of limbo where you either join the herd on something which you don't understand, some wild hunt, or you have
Feel left out and lick your wounds and say FOMO.
Yeah, you have to be content with like getting albeit decent returns with very
No, but when you compare yourself with your imaginary returns.
Of course, it's going to be painful.
Yeah.
However, Warren Buffett said that I could make my money without investing in automobiles or aviation, which means that we can make our money without investing in the new, great, brilliant, beautiful looking idea. We can invest in things which are undervalued, buy it when it's undervalued, keep it, hold it, and watch it till maturity until the point where it becomes a full-fledged company which Mr. Market recognized that it mispriced long ago. So your portfolio is going to be filled with these gems, and when these gems do mature, you're going to have a wonderful looking portfolio. And all I can tell you at home is that don't lose hope when you see a market like this. You do not have to get into risky behavior to make the returns that you have to, because remember, this is the long run. You're going to be looking at the next 10 years, the next 15, 20 years even. Don't get disheartened by seeing a few AI companies doing well and you not being able to pick them up because you're following the Warren Buffett way of investing. I would say that you are doing it right, and those people need to re-examine what they're doing, because if we actually look at the AI companies, they've already declined quite a bit as we make this video, and we're not sure, maybe it'll go up 20% from here. But the point is, you don't need them to make money in the stock market. And that's what the Warren Buffett article tells us.
Yeah. And so what is the key takeaway from here? Like, okay, Vinod, okay, Sashwath, you told us all this. So what do I do now? Well, here's the gist of it. The gist of it is, 1, stay in your circle of competence. So what is my circle of competence when I break it down? I break it down like this. We are human beings. As long as human beings are alive, we require certain things. And there are certain companies making these certain things, which will always be required because I have a human body. What is that? Medicines. Till they can find some way of not requiring a human body, I will always require something pharmaceutical. Because I have a body. AI can do many things. But AI is not going, as of now, there's nothing in the imagination that's going to get rid of my body. So I'm going to require something regarding pharmaceuticals. Then my body, I need to eat. It requires fuel. So I necessarily will have to eat. So companies related to food, related to pharmaceuticals and IT, because our world now is the backbone of our world is IT, not AI. I'm talking about information technology,
Basic network management.
Yeah, network. You need basic software. Any kind of hardware for AI to be used, you need. So I'm not saying immediately look at NVIDIA. So just expand your scope. So I would say like food, pharma, like that, break it down. These are my circles of competence. So I know I need this. So then try and find value in these areas, right? There are companies which the market is ignoring. Maybe there are 20 pharmaceutical companies, 40 pharmaceutical companies, but the market will be ignoring 2, 3 of them. Why? I don't know. Market just tends to be like
moody.
That. Yeah. Like how parents are with their children. Some parents love the first one, the second one, the third one, or the last one. And it's always not. Parents will claim they love everything equally, but you can see in the behavior, it's like that. So for some reason right now, the last son or the first son is not in favor because they did something wrong last night. It keeps
changing.
Yeah, it keeps moving around. Same thing is true in the market. So when you look at 40 pharmaceutical companies, you'll find 3, 4 which are there, which market is ignoring, which doesn't have debt, which is on value. Look at it. Same thing with food. There'll be like 50, 60 food companies. Great companies. Nothing wrong. Long history. But market will be ignoring a few of them for some odd reason or another.
Because there's always an NVIDIA or a...
Yeah, something they're chasing. So they're dropping this, chasing that. Like Sashwath said the other day, the market was crashing, but even gold was crashing, which is rather weird because the people are selling their gold to cover positions. They're selling gold to buy trash.
Yeah.
So that happens in the market sometimes, believe it or not. That's what we are saying is a temper tantrum. So if you look at it like that and you analyze it, there will be pockets of value here and there. That's what Warren Buffett also did. So do that. You have a lot of time, especially when Shashwath's generation. You have time in your hand. You have nowhere to go.
All we have is time.
Yeah. So take your time, pick those companies and keep going at different coffee levels. Don't go drop your entire
life savings,
college fees into it. Start small. Keep ticking away. Nibbling here and there, nibbling there, here, there. Before you know it, you have started accumulating huge amounts of money because as you are keeping nibbling, what you've already nibbled is growing. So when suddenly 5 years later you turn back and you look really great. Mostly everything which you picked will be looking green, looking massively green because you've been buying it at value.
You just need to do slightly better than average over the long run to be able to be in the top 5% of investors.
And like what Warren said, the economy keeps growing at 3%. Businesses will keep growing. People keep eating. People keep needing pharmaceuticals, hospitals, everything. So it will keep ticking along. As long as you keep picking the right companies at the right values. You should not worry about it.
Yeah.
Don't get swayed by AI or the next big thing or the market crashing or going up in flames, seeing it going like this, like that. There, what Peter Lynch Fisher says should come into light and focus on what you know and keep nibbling away like a small squirrel. You'll make it through winter. Don't worry.
Right. So that being said, thank you for watching this video. We hope you enjoyed the 2-part series. If you like more of these longer format content, please let us know in the comment section below. That being said, if you liked it, please hit the like button. Please subscribe if you haven't already. Hit the bell icon if you want to be notified of when we drop our latest video. And if you have any other comments, please do leave them in the comment section below. Thank you very much for watching. Be rich.
Thank you.
I told you about visiting Singapore. The date has been finalized. It's 25th August. It's a Sunday. Those desirous of meeting me in Singapore can drop a message to the WhatsApp number given below or contact my team by an email. My team would reach out to you and we will assure you of our best services. For English and Hindi, there will be a separate meeting. See you in Singapore. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.